All right, welcome everybody. I know we got a couple people that were waiting. I want to let you guys in. You're probably seeing a newer face, or maybe not that new since I'm on the other show, but you're probably expecting Aaron, and obviously I'm not Aaron. If you don't know me, my name is Lee Gearhart. I do a lot of things with customers, whether it's sales, customer service, all that sort of stuff. So if I don't know you yet, welcome. And of course, we got to bring in the main star of the show, Kelly. Let's get you on here. Hey, Kelly, how you doing tonight?
Good evening, everyone. Good evening, Lee. I'm managing an afternoon, a late afternoon.
Yeah, it's that weird point of year where you and the states that don't switch their clocks back are an hour ahead of us over here on the West Coast. It's a crazy time of the year.
Yeah, it is. I kind of like this no daylight savings time thing.
You guys don't really have to worry about that with all the sun that you get, though. So, anyway, I digress a little bit. Welcome, everyone. And before, obviously, we get into any of the market stuff, we will have to do that fun disclaimer. I think that's why Aaron's having me take his place. I don't think he wants to read it anymore. Any first thoughts or anything you like to say before, though, Kelly?
Um, well, let's get the disclaimer out there, and then all the thoughts will just spew out as they normally do
Sounds good.
over the next 25 minutes.
Perfect. Well, as you guys have probably seen this thing before, we do have to read it for you. So, as the disclaimer, iFlip Investor and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak to your CPA or financial representative to ensure that the iFlip Smart Folios that you select are suitable for your investment profile before trading in a live brokerage account. So, with all that out of the way, Kelly, I think it's your time to shine. Let's let those thoughts spew out of your brain.
Now, let's see. Well, if I have to talk about shining, I think I have something what we used to call as a shiner, like a black eye. The last day I circled to today. So, everybody, again, welcome. Happy Wednesday, late afternoon on November prior to Thanksgiving of 2023. And we're going to get right to it as we generally do with this show. And keep in mind, I'll update everybody on progress of smartfolios as they correlate to the way we look at the markets through technology. All right. Hopefully, everybody. Again, as you know, I show screens, and screens are what really matter. We're looking at the S&P 500 spider when we look at this chart, and obviously the last 8 days have been a real barn burner. We have saw a massive rally over the last 8 days that literally recovered all of the loss that we had over the prior 10 days. So, as you've known from my last meeting, I was essentially very adamant that the market was going lower based on the last Wednesday that we had an AI circle. And by the way, that was this day right here, which would be October 25th. And so on that day here, I was right for like 2 days. And the following Thursday and Friday closed low and last on the markets. And that was the reason that was occurring, because interest rates continued to rise to the 5% level on the 10-year note. And as you know, everyone, last week I pointed out the obvious correlation between the S&P 500 and the long bond, which is the 10-year note. We're going to call it the long bond, which is really just a 10-year note. And what a difference a week makes. But why did this occur? Was it something that happened in the market? Did Jerome Powell say anything? Did the markets do anything different? So let's kind of do a little look back and see what we saw, why the market rallied, and what to expect going forward in each case. So what we saw the last Wednesday when we were here, if people can see it maybe a little closer, that day there, we had a couple of numbers come out. Of course, there was the unemployment number that came out on Friday, and the unemployment number actually was a little bit weaker, but the market still went down. And the day before, we had GDP numbers. That Thursday, the GDP numbers were actually unusually strong. So the stronger market makes people and market participants feel that the Federal Reserve is going to keep rates here or raise them. And if they raise them, you don't want to be in the stock market because those bonds, those notes become competing investments with much less risk. That's what happened. So we had a very strong GDP report on Thursday, the day after our last day I circle, and the following Friday, we had actually a little bit weaker job numbers. Generally, weaker job numbers allow the Fed to be able to say, hey, maybe we don't have to raise rates anymore. Nonetheless, the market was in such a bad move, it still went down a little more on that final Friday. And we closed kind of low and last. And by the way, we closed down on the year at that point. This is the S&P 500. Sorry, if we go to the Dow, I'll go back to that. This is a year to date of the Dow. During that time, we actually were down on the year by about 2%. However, the Dow put on almost a 6% rally beginning the week ago Monday. And here it was, that first day. And then we had that big 500-point day, if you guys remember. And we recovered it all. So we moved up almost just under 7% from being down 2. The Dow Jones now stands up to be up about 4.5% on the year. That doesn't seem, for such a big rally, and for so many people to believe that the market is in good shape all of a sudden because the 10-year notes have backed off, kind of seems kind of miraculous to me. So let's look at what caused that rally, and let's go right to it. Here it is. This is the 10-year note. Just as I've been saying, the interest rates over the last, since COVID, and here's the COVID pricing way back here. Since COVID, interest rates have been going up. But since the last Wednesday, that day over here, when the market was struggling, where was it, market 25th here, the bond market has rallied, which means the interest rates have gone down. Remember the inverse relationship. So this little rally from 5% on the 10-year note to literally 4.5% on the 10-year note is why the Dow, the S&P, and of course the Magnificent Seven turned around and conquered all their demons, literally in a week and a half. So this, I think, is making a lot of people sanguine that maybe the market is done going down. The interest rates will not be raised any further. Here's my take on it and where I think it goes going forward. I do agree that I think it's going to be very difficult for the Federal Reserve to raise interest rates between now and the first quarter of next year. The only thing that would do that is if we continue to see some stronger numbers coming out from next month's employment report, which is a month away now, and also because of any kind of other numbers, GDP numbers, that now will be another 3 months from now. So other indications are that the Federal Reserve did want to raise rates, but now the information is that there's only a 15% chance that the Fed will hike rates any further in the short end, on the short end of the curve, Fed funds rate. So what does that mean? At the end of the day, it means that we're probably going to stay in a range bound for now on the short-term side of interest rates. But let's go back to the long-term rates. And to me, when I look at this overall trend, which is extremely bearish since COVID, there is no reason to think that just 8 days ago we put in a bottom. Longer rates are not controlled by the Fed. The Fed does not control this product. We also know that in the coming weeks, the US government is going to have to finance a great deal of long-term bonds. They're basically going to be literally issuing a lot of 10-year notes. And we will see what the appetite is of consumers to buy those notes. If the appetite is good, the rates will stay here, and we may see a continued rally in the bond market, which means interest rates will go even lower. And that does bode well for the stock market. However, interest rates trend deeply. And just as the stock market seems to appear to be trending higher, if you go back 3 years on this stock market, I think we will find, going back to here, which is April of 2021, going back a couple of years, 2.5 years, we are nowhere. The market is at the same place it is now it was 2.5 years ago. The main thing is interest rates have gone much higher. And that tells me that this is the leftover lag effect of all the capital, as I've been pointing out, that was put in by the government into the economy to manage COVID. And since COVID is no longer here, that money is no longer being given away, but it is still out there. It is still being spent. And eventually that money will dry up. And when it dries up, it would be hard to explain that if interest rates at one time 2.5 years ago were at 3%, that now when they're at 4.5%, why is the stock market at the same price? It shouldn't be. It should be lower. These two products compete for assets, bonds and stocks. So to me, the pricing is wrong. I call this a dislocation, and I still remain on the short end of the curve. I believe that the stock market is not done exploring lower pricing. So what would support that particular argument? Well, we know a lot of economic things would support that. We're trying to spend another $100 billion, albeit that seems small given the trillions that were put it out for COVID. But that's just for a defense part of a budget to be able to protect now another war that we had just started a month ago, literally a month ago, October 7th, when Hamas came into Israel. So we have a new war. That war is intensifying. That does not bode well for prices, despite what Ken Fisher says, buy when you see the bullets. Well, if that's the case, then it won't explain many cases in history as to maybe he could have bought that 20% cheaper when the bullets flew. Again, reliance on old values that the market just always goes up is not enough information for me to be long the market. And that's why our systems, the smart folios, are still holding back on so many stocks. It simply feels that there's a better investment somewhere else than there is in stocks. The thing, again, that it sounds so redundant, and I feel it becomes an old argument, and I won't stay on it more than a minute. But again, it is still the 7 top stocks: the Apples, the Amazons, the Googles, the Metas, the Microsofts. By the way, I cannot buy Microsoft at an all-time high. I'm sorry, not worth it. To me, this is a massive short. But if people want to own it here, that's up to them. It's not going to be owned in any smart folio. I might manage that to be called a dumb folio. Then we have Netflix, of course, that even though they reported bad earnings and reduced viewership, on some cases, they somehow managed, which is why they went down. But the rally literally took them back up. There was no news here. Let's go back to NVIDIA. This is the stock that when it was at 500, they thought it was going to 650. It hit 400 or 398 first. So it went down 20% before it went up the same 20%. Right after they thought it would go to 650. Again, the analysts are behind the scenes, are always late. Tesla has not looked good for a while. It has recovered a little, but notice it didn't recover so well. Nowhere near as well as like an Apple did, or look at an Amazon, how it really did a great recovery from literally 118 to 142. No, thank you. What we do have, though, in the short run that I also must point out is we do have a seasonal effect. Yes, Santa Claus always seems to be around, and Santa Claus generally brings the market up. I can't deny that. But that being said, I don't look for that to be much of the same issue as it has been in previous years. I think the country has still got a lot of issues, and I think they just need to unplay, and especially the bond market, which I do feel, going back to the bond chart, I'll bring it, make it bigger. But when you go to this chart, this is a chart that has been going down. I think rallies should be sold here. If rallies are sold here, that tells me you should sell rallies in the stock market. So let's put that aside. Let's look at the oil energy sector. Now, the energy sector, real quick, because this has been a one leader. But interestingly, if the Fed doesn't have to raise rates anymore, what is the reason that oil have moved from just $90 a barrel to $80 a barrel? That small move of $10 somehow has hurt the oil companies, and they're just at the end of the day. Here's Exxon. They're all at the lower end of their range, including some of our lost leaders in the pipelines, like Energy Transfer and All Plains American, stocks that I really like. But just keep in mind, 3 days ago, they made an all-time high. So these are things that are backing off because of oil and maybe demand destruction. But again, these things seem out of kilter, because why would, if they feel there's going to be demand destruction in oil, then why did the stock market go up? It's not because oil is cheaper or there's less of a tax. It went up because the nature of the stock market today is to look at the Federal Reserve and only key in on that and what they're doing. And I believe that, sadly, this country, that the people and investors in this country are completely in agreement that we will at some point return back to a 2% federal funds rate. And I, for one, do not see any of that. I see Fed funds staying in the 4 to 6% range. They're sitting now at 5.3 for the near-term future. I do not see rate cuts, which is what I think the market is anticipated. So this is one of the reasons why Smartfolios, for everything from red oil, aggressive, balanced, conservative, have just treaded water over the last year, marginally higher because of the dividend aspect of these portfolios. But the markets have not really given us anything. The one thing the markets have given us, though, is the ability to make money on our spare cash. That's one of the reasons why we promote to say we will build an ETF portfolio for everyone, where it invests literally in short-term rates, where you can actually earn a yield just like you were in a bank CD, different product, when you're on the iFlip platform. Make it very easy for people to put their money to work in a very safe, interest rate sensitive product that's giving you about 4.7% with very little to no risk. So those are the main things being said. Let's, by the way, take a look at the rest of the world and the dollar. Let's look at the dollar. As we've thought, the higher dollar, the stronger the dollar gets. This is the dollar index, DXY. The stronger the dollar gets generally is not good for the stock market, because, again, it makes it more expensive for foreign money to buy our stock market. So, but you might notice that the dollar did get a little bit weaker over the last week, but the stock market didn't care about that. It really just wanted to do its own thing because of the bond market. So that's something to note. By the way, I think it's also worth noting, let's look at the Russell. This is the Russell year to date, which is down. It was down 7%. But then the Russell last week actually was the biggest product over the last 8 days in this rally. Took the Russell up 8%. Literally up 8% in 5 days. These 5 trading sessions brought the Russell all the way back. But look what it's doing this week. It's already given back one Fibonacci number of 382. That's just generally the way these numbers are. I suspect that the Russell will go back down to its lows. Why? The Russells are the smaller stocks in the US. And they're kind of an indication of what most businesses experience. It's not what Apple or Microsoft experience, it's what most businesses experience. And this chart looks awful. This doesn't look like a chart that I would buy. It looks like actually a chart that I would sell. If I turned it upside down, that chart looks like I might buy it, but it's not. So the Russell, although it had its rally, the Russell is falling off. It's just the main stocks, the S&P 500, and of course the Nasdaq, that decide to do these crazy big rallies. And by the way, let's point something else out. Notice where they're priced here compared to where they were just literally a month ago. Here's October 11th of last month. There they are. That's when, if we look at the bond market, we'll see that that's exactly where it was also on October 11th. So it only retraced what the bond market gave back. This market is fundamental to follow, folks, the 10-year note, the bond market. Let's follow, just keep your eye on that and we'll know where the market is going. So that gets to the stock side. Let's take a nice, another little look at the dollar and be a little closer. We must talk crypto first. Sorry, must talk crypto. I don't know what else to say. I think this is kind of a very noticeable chart. This is Bitcoin. I don't think I need to tell anybody that Bitcoin is on a tear. It's at 35.8 as we speak. And over those last number of days, we are just grinding higher. This is a market that honestly is very likely it's going to go back to these highs. I feel there is a chance that sometime in 2024, we will see these old highs again. We have many reasons for it. One of the main ones, of course, is that BlackRock has now been approved to have their ETF. And that's a game changer, folks. That means this particular investment definitely will have longevity. It will be tolerated by the SEC. It is right now managed by something called the CFTC. It's a commodity. But over time, this market, if you are holding Bitcoin, I recommend you hold it and do nothing with this. This market looks to me like it's going much higher. However, it's at the expense of some other things. If we look at Ethereum, yes, it's rallied, but you know what? It hasn't even made highs that we saw earlier in the year. And if we look at Litecoin, I think we see much the same. These highs that we see here are nothing like what we've seen in Bitcoin. So what's happening is this is where I feel the market will bifurcate. All these smaller coins, folks, in my opinion, again, I'm opining, and that's why we have a disclaimer. These things will all go away into the debris of history. These things will not last over time. It is the Cadillac, Bitcoin. If you own that, you're going to be in good shape. If you own the others, my opinion would be to sell them and buy Bitcoin. So this is my opinion, at least. I know many people don't hold it, but I have to hold it. And then let me finally get back to one more thing. Again, going back to foreign exchange. Look at the euro dollar. Nothing much. It had a little tiny rally over the last 8 days. The dollar, again, it's representative of the dollar. The dollar really didn't move. This has all been a rate play. And this is true, by the way, around worldwide stock markets. They didn't have the rallies that our country did. And their markets are generally mixed. Up 5%, down 5% across the board between FTSE, Germany, France, UK, and what's my country? Spain. So I'm thinking, and also as well as China. By the way, China is rallying. I won't go into it. And the Hang Seng is actually also doing well somehow in the Asian markets. So I think right now I ran my course on the markets, and I think we need to put up the trivia question, Lee. And I know we might have some questions.
Yeah, we will in a second. Your there's so much good stuff in there. You indirectly alluded to the new Smartfolio. I'm not sure if you wanted to discuss that anymore, but that kind of solves your problem you were talking about with maybe some stock market decline that you never know, might be here sooner rather than later.
The way to elaborate on that is there will be a new portfolio available very shortly. If not, it might have rolled out today.
Actually, yeah, I was just going to say I was doing a demo this morning and I saw it on there, so it is live.
So, folks, what that is if you buy that, you're buying two ETFs just to be marginally diversified of huge companies, and all those ETFs do is buy treasury bills, and they buy them and they mature within 2 weeks, and then they take their interest. That interest works out to be between 4.6 and 4.7% currently. If you own those things, they will just generally pay you 4.6 to 4.7, and you will get a little baby distribution once every month. So every month it pays you a little yield. And they give it to you in the form of a dividend, and they're safe. They do not go up and down. They just trade between $50.30 to $50.40 a share kind of thing. And that's all they do. And they just make money, and it makes it at that rate, and you have no risk. It's a good place to park your money if you don't believe in the stock market. And if the market does go down, you'll have an opportunity to buy it much cheaper and earn money in the meantime. All of our portfolios are designed around these same kind of concepts because they're owning generally stocks that pay dividends. But the main difference is that if you own an ETF that is a money market ETF, there's actually no risk of the underlying components. It's just the dividend. And that's a big difference. And it's if you have $10,000 and you know you need $10,000 3 months from now, you would buy that.
And it doesn't tie your money up, right? Unlike a CD or something.
Money, it's better than a CD because guess what? You may not get as much yield, but you can buy, and you have the cash of that in 2 days. And that's a whole lot better than thinking that if I do need the money from a CD, I go in, I lose all my interest, and I pay a penalty if I need the money. Whereas with these products, there is no penalty. You always get paid. And that is it's a huge difference. It's a great place, and it's where the real world parks its cash.
Absolutely. Well, thank you for touching on that again. You alluded to it, and I was like, I just want to make sure, because we don't come out with portfolios like every single day, nor do we need to. But it's a big one, especially for what's going on in the world right now. So my last thing before we get into trivia, I alluded to it at the start, but since the time has changed and all that, we're actually going to move the AI circles up an hour to be 2:30 Pacific, 5:30 Eastern, at least through the remainder of the year. And we'll communicate with you guys if we do change that at all. But Kelly being an hour ahead of us, it's a little bit late for him. So we want to make sure that everyone can attend still, but also not make it, 9 o'clock at night for anyone as well. So that's my only announcement. With that being said, Kelly, you ready for your trivia question? I know you know the answer.
No, since I was the one that figured it out and made the question, I do. But if you want me to read it out, okay, folks, what was the longest winning streak for the Dow Jones Industrial Average?
And when you say winning streak, what are you looking for? So you were probably about to say that. Sorry.
How many days was the longest winning streak? The reason I make that question is we just know that we had 8 days in a row up for the S&P 500. But what is the longest winning streak that we have ever seen for the Dow Jones Industrial Average? And we can now play the Jeopardy theme for a little bit, or people will Google and quickly get the answer. But I really hope that you could hopefully come up with the answer without it. Yep.
And just as a reminder, I glossed over it, but what's at stake here? So there's a $25 Amazon gift card for the first person that gets the answer correctly. And like Kelly said, it is in days. So if you want to start typing from 1 to 100 and hope you get right, I guess that might be one way to do it, but we'll see.
We know the answer is not 1. We know the answer is not 100.
Or is it?
Yeah. It's interesting to see the market, even this last week, as everybody's thinking of the answer, even this last week, just watching the market go up every single day. It was almost like the week before where it went down every single day.
Right.
So when the markets go down every single day, people are bearish and they're trying to get out. And when it goes up every single day, they have fear, and their fear makes them buy every day, for they afraid that, oh, I'll miss out. And so it's not investors, folks, by the way. It's funds moving their money. It's just funds. There's no investors anymore.
Right. I'm not seeing any answers so far. This is a little.
No answers. I'm a little.
You might have stumped them again.
No way. No way. I think it's the first answer on Google. Longest winning streak.
Giving them the answers of the test now.
All right. Well, we got to get somebody to come in, and if they don't, what do we do?
We'll have to push it back to the next time.
We need a shill out there.
We have one answer.
Jonathan.
I don't want to give anything away. It's not the correct answer, but it's pretty dang close.
It's close.
Tell you what, if we don't get another answer within the next 2 minutes, Jonathan's going to be our winner.
That's right. Go, John, go.
We do need
music. All right, everybody. I think since we're not hearing anything back, we might want to cut the buzzer short.
All right. Well, let's show the answer first, and then we'll reward Jonathan. So, Kelly, if you want to add anything to this, feel free.
There's nothing else to add. Normally, Aaron gives the answer out, and 63 Price Right rules. What's 63 days? No, everybody, the answer is 13 days, and it occurred in January of 1987. 16 days. Wow, give me that one. The 13 days for the Dow Jones that occurred in January 87. When I see that, I kind of remember coincidentally that year, which I thought was kind of amazing, because that was the year of the 87 crash of that October.
Right.
And the person I was working for at that time kept on looking and watching the market go up and up and up relentlessly. And he was in it long, but he was trying to find when he should sell it. And every Thursday, we would go into a room and talk to these technicians that would come into the office. Yep, you have 1897. Well, you know what, Jonathan? Yay. I'm not going back to 1897. Stock market, that's 100 years after that. There we go, 13 days. There it came in. What ended up happening was that later that year, after much ado, it took all the way till October before the market lost its 25% in a single day. And so I kind of recollect that when you see markets go up like that, and with that kind of frequency, with no ebb and flow, it tells you that the market is jittery. It doesn't know if it should be in the market or out, which tells me that now the institutions that run the game, they don't know where to put their money. And they just put it away because they're supposed to. So at the end of the day, I don't think we can make any kind of decision that later this year that the market will fall down. But the answer is 13. So Jonathan, you were the first person close before we cut it off. So you are the winner.
So congratulations, Jonathan. So all you need to do is send us either your account number or a screenshot of your iFlip account. As Aaron always says, it's not good enough that you just got the answer right. You do need to show that you use one of the smart folios. I know, Jonathan, that's going to be no problem, but please send that to mailbag@iflipinvest.com. Any parting words, Kelly? Or are you ready to get some dinner?
No, I just want everybody to look. We're into the holiday season. Just know, let's see if we get a little Santa Claus coming up over the next couple of weeks into December, and until and I want everybody to enjoy it and have a nice, safe holiday season. I want to be the first person to say that to everyone. And again, thank you for attending the AI Circle. And we welcome Lee to help me doing this going forward. And I know Aaron will fill in periodically as well. But thank you, everybody. And thanks for listening in. And I'll have more content in 2 weeks. So all the best.
Awesome. Well, have a great night, everyone. Thank you for joining us, and we will see you again in a few weeks.